A woman walks into a bank on a Tuesday morning. She is young. She has a job. She opens a savings account and commits to one single discipline. $200 every single month, no matter what. For 20 years she sticks to it. 20 years of deposits, 20 years of showing up. She puts in $48,000 of her own money. Her bank statement shows her savings grew to $48,094. $94 earned on $48,000 invested. That is 0.2%. But here is what she never sees. The bank took every single dollar she deposited. They lent it out, most of it at rates between 7 and 25%. They profited hundreds of thousands of dollars, while she earned crumbs. You think your bank is storing your money. You think of your savings account like a safe. It is not. It is nothing like a safe. When you deposit money into a bank, that money becomes theirs. Legally, you become a creditor. The bank owns your cash. They owe you interest. But that interest, it is calculated to be as small as possible. They pay you almost nothing while they lend your money at enormous rates. This is not an accident. This is the entire business model. And nobody teaches you this. Nobody ever explains it. Buffett knows how banks work. He does not just know the theory. He owns multiple banks. He sits on the other side of the desk. What he sees from that vantage point is that banks are money-collecting machines. They take your money when it costs them almost nothing. They lend it back to you or to someone else at rates that make them wealthy. The system is so efficient, so predictable, so profitable, that once you see it, you can never unsee it. Stay to the end, and you will understand both sides of the equation. If nobody ever explained how banks actually make money off your deposits, subscribe to this channel. This is where we turn the complicated into the obvious. When you make a deposit, you think you are doing the right thing. You believe you are being financially responsible. Everyone tells you, put money in the bank, build an emergency fund, save for later. So you do it. You hand over your cash, but the moment it hits that account, something shifts. The money stops belonging to you. The bank now owns it. They can do with it what they want. You get an interest rate that barely keeps up with inflation. They get everything else. This is fractional reserve banking, and it is legal. Here is how it works in the simplest terms. You deposit $10,000. The bank is required to keep a fraction of that on hand, let us say 10%. They lend out the other 90%, $9,000. They charge that borrower 8% interest. The borrower pays them $720 per year. The bank pays you 0.01%, which works out to $1 per year. They make $719. You made $1. They keep 682% of the profit from your own money. This is not a loan. This is an extraction. A century ago, people started to figure this out. In 1907, there was a bank run. People realized that the bank did not have their money. The bank had lent it all out. Everyone rushed to withdraw at the same time. The bank could not pay them. They lost everything. J.P. Morgan, the person, had to personally intervene to stabilize the financial system. That is how fragile it was. That is how obvious the illusion was. Then in 1933, after the Great Depression exposed the lie again, the government created the FDIC, Federal Deposit Insurance. But that insurance was not a sign that banks changed. It was a sign that banks admitted the truth. We do not have your money, but we will insure you in case we collapse. The spread is the technical term. It is the difference between what banks pay you and what they charge others. They pay you 0.01%. They charge credit card customers 24.7%. The difference is 2,469 basis points. That difference finances every skyscraper, every CEO bonus, every shareholder dividend. J.P. Morgan Chase, the largest bank in the country, made $50 billion in profit in 2023. $50 billion. That is the largest profit any bank has ever made in a single year. Where did $50 billion come from? The spread. Your money lent at rates you never agreed to, generating profits you never see. Think about it like this. You lend your car to someone. They use it all day as an Uber. They earn $200 driving your car. At the end of the day, they return it to you with a 2-cent thank you note. That is what the bank does with every dollar you deposit. They take your asset, they make enormous profit from it, and they hand it back to you, having converted almost all of the benefit into their own wealth. You did the work by saving the money. They did the work by managing your money, but they captured $199.98 of the value. You got 2 cents. If you never thought about your deposit this way, write in the comments. I see the blind spot. Banks do not stop at the spread. There is another entire revenue stream that most people do not even realize exists. Overdraft fees. You have $48 in your account. You buy a $5 coffee at 8 in the morning. Balance is now $43. You buy gas for $50 at 10 in the morning. Balance would be negative $7. The transaction is denied. But the bank does not just say no. They say no, and they charge you $35 for saying it. So you now owe them $35 for a transaction that never went through. Plus, your original $48 was not enough for the gas anyway. You're down to $0 with a $35 fine for asking them to lend you money they already rejected. The order matters because banks reorder your transactions. This is real and it is documented. You have $100. A large debit of $80 comes in. A small debit of $15 comes in. A small debit of $5 comes in. Most people would think the bank processes them in order, 80, then 15, then 5, one overdraft. But the bank does not do that. They process them largest to smallest, 80, 15, 5. But they also reverse the small ones. 80 gets processed, then another debit triggers another overdraft fee, then another. The bank now charges you $200 in fees to process $300 in transactions. This is not accidental inefficiency. This is intentional design. It is so profitable and so widespread that banks have been sued for it, repeatedly, and they have settled for billions. Then they went back to doing it again. $35 billion per year. That is how much Americans pay in overdraft fees in a single year. That money does not go to charity. It does not go to interest rates. It goes to bank profit. And it does not come from everyone equally. Studies show that 80% of overdraft fee revenue comes from just 9% of account holders. The most financially vulnerable people in America are generating the most overdraft profit for banks. The system, by design, extracts the most from those who have the least. This is not a side effect. This is a feature, but overdraft fees are just the beginning. There are NSF fees, non-sufficient funds. You submit a check. The bank says no. They charge you $35 for the no. They did not lend anything. They did not manage anything. They literally just said no and charged for it. There are monthly maintenance fees for keeping an account open. Minimum balance fees if your account drops below a certain level. Wire transfer fees. ATM fees if you use another bank's machine. Paper statement fees. The average American pays $300 per year in bank fees. Over 40 years, that is $12,000. $12,000 in fees, not counting what that $12,000 would have earned if it was invested instead. The true cost is double, maybe triple. If this is starting to change how you see your bank, hit the like button. It helps this reach more people who need to hear it. The spread works in one direction most of the time. Banks profit from the difference. But the spread is not static. When the Federal Reserve raises interest rates, the spread actually widens. This is the part that really matters. When the Fed raised rates to 5.3% in 2022 and 2023, banks immediately bumped up their lending rates. Mortgage rates jumped, credit card rates jumped, car loan rates jumped. But what happened to what they pay depositors? Almost nothing. Savings accounts stayed at close to zero. Money market funds moved slightly. But the increase was nowhere near proportional to what they were charging borrowers. In 2023, the Fed rate was 5.3%. Bank savings accounts paid 0.01 to 0.5%. CDs, if you locked in your money, paid 4 to 5%, but you had to give them the right to keep your money for a year or more. Credit cards charged 24.7%, mortgages cost 7% or more. The bank was making enormous profit on every side of the equation, on the borrowing side, on the lending side, on the deposit side. The spread did not just stay wide, it got wider, it got thicker. The more desperate people became to find returns, the more the bank could extract. Buffett says that banking is a very good business if you do not do anything dumb. This phrase is famous in investing circles, but people miss the real meaning. Banking is good because it is mathematically biased toward the bank. The spread guarantees profit, volume guarantees profit. It's almost impossible to lose money on deposits because you are not actually lending. You are just taking free money and charging others to use it. Buffett understood this so thoroughly that he decided something radical. He would never be the depositor. He would be the bank. He would be the one capturing the spread, not the one subsidizing it. The FDIC publishes data every year. In 2023, all U.S. banks combined made $256 billion in net income. $256 billion. Divide that by approximately 130 million households in America. Each household contributed almost $2,000 to bank profits. $2,000 per household per year. Most people have no idea this happened. They think they have a neutral relationship with their bank. They think they are just storing money. But every person in America, just by having a bank account, is subsidizing the bank's profit machine to the tune of nearly $2,000 annually. Let me put this another way. Your money is the raw material. Banks buy it cheaply, paying you almost nothing, and sell it expensively to borrowers. You are the supplier in a supply chain you did not know existed. You are upstream in the bank's production process. You provide the input. The bank transforms the input. The borrower pays for the output. You, the supplier, get paid less than the bottle of water on the CEO's desk costs. You provide billions in raw material, and you are compensated in single-digit basis points. Compare this to any other industry, and the structure collapses under absurdity. A grocery store buys milk at 2 cents per gallon. If they sold it for $25 per gallon, there would be outrage. The store would be shut down. People would protest. But a bank buys your money at 0.01% and sells it at 25%, and everyone thinks that is normal. Nobody protests. Nobody even questions it. The reason is simple. Nobody thinks of a deposit as a sale. You think of it as storage, but it is not. It is a sale. You sold your money to the bank. The bank is reselling it at a massive markup, and you agreed to it by clicking a button you did not read. If you understand the spread game but do not know how to get to the other side of it, if the math makes sense but the movement has not started, there is something waiting for you in the first pinned comment. It is for those who are ready to stop being the raw material. Credit cards are engineered for debt. The minimum payment is not designed to help you. It is designed to trap you. This is documented. This is intentional. A $5,000 debt at 24.7% APR sounds bad. But if you pay just the minimum payment, say $25 per month, you will not pay off this debt in 1 year. You will not pay it off in 5 years. You will pay it off in 34 years, 34 years of payments. By the time you are done, you will have paid $13,000 on $5,000 borrowed, 2.5 times the original amount. This is not a mistake in the system. This is the system working exactly as designed. The minimum payment is calculated with a specific formula. The formula is designed to maximize interest. It keeps you paying just enough that you think you are making progress, but not enough that you actually make progress. It is like running on a treadmill. You are in motion. You feel like you are moving forward. But at the end of the day, you are exactly where you started. It is a psychological trap wrapped in mathematics. Banks studied this. They know that most people who pay the minimum feel like they are trying. The payment goes to their bank account every month. It feels like progress. Meanwhile, interest accrues. It snowballs. 34 years go by. Most people do not realize how credit cards work. You have a $2,000 balance. The terms say, if you pay the balance in full by the end of the month, there is no interest, zero. So you pay $2,000 when the bill comes, no interest. But if you pay $1,999, if you leave even $1 unpaid, the credit card company does not charge interest on just that $1. They charge interest on the full $2,000, the entire balance. This is called the grace period trap. It is in the fine print. Almost nobody knows it exists. Most banks make more money from people who pay 99% than from people who pay 0%, because those paying 99% think they are almost done. They do not realize the entire balance just became subject to interest. Buffett has talked about credit card debt more directly than almost any other financial topic. His position is unambiguous. If you owe money at 18% interest, the first thing you do is pay it off. Full stop. He compares paying off credit card debt to investing with a guaranteed return. If you can pay off 18% debt, you have eliminated an 18% loss. That is mathematically equivalent to making an 18% gain. There is no investment in the world, no stock, no real estate, no mutual fund, that guarantees you 18% returns. The highest return on earth that you can guarantee is paying off high-interest debt. That is not hyperbole. That is mathematics. Yet most people ignore this and keep the debt, hoping for returns elsewhere. Credit card companies make this worse by wrapping the trap in rewards. You earn 1% cash back. You earn 2% on groceries. You earn 5% on travel. These seem valuable, and they are valuable to the credit card company because studies show that when people use credit cards instead of cash, they spend 12 to 18% more. The rewards program is the bait. The higher spending is the result. Banks call it driving engagement. You call it having fun. But you are spending more, carrying more debt, and the rewards hardly cover the interest you are paying. The cashback is a lure. The interest is the hook. Late payment fees amplify the trap. You pay 1 day late. The bank charges $40. Your interest rate, your penalty APR, jumps to 29.99%. One late payment. 1 day, and now your interest rate is nearly 30%. On a $5,000 balance, that extra 5 percentage points is an extra $25 per month in interest. Over a year, that is $300 extra. One late payment costs you hundreds of dollars over the following year, on top of the $40 fee itself. The system does not forgive. It capitalizes on forgetting. Your credit score is a tool. The FICO score was created in 1989. It is supposed to measure creditworthiness. But what it actually measures is something else entirely: how profitable you are to lenders. It does not measure financial health. It measures lending profit potential. The system rewards people who use debt, not people who avoid it. If you have zero debt and $100,000 in the bank, your credit score is worse than someone with 3 credit cards, $10,000 in balances, and a car loan. The person with more debt has a better score because they are paying more interest. They are more profitable to the system. The scoring system does not care that they are broke. It cares that they are paying fees and interest. Here is the real trap. The score forces you to play the game. No credit history means a lower score. No credit history means higher interest rates when you need them. So even people trying to avoid debt find themselves forced into debt just to build a score. The system punishes abstinence. It rewards participation. You cannot opt out. If you want a mortgage someday, if you want a car loan, the banks will pull your score. That score determines what you pay. And that score was created by banks, for banks, to maximize bank profit. The irony is that Buffett, the oracle of investing, has never made a single financial decision based on a credit score. He does not care what Fisio thinks. He looks at business value, not at what a scoring system says. The score is not a financial diploma. It is a bank tool to price you. Here is the part that changes everything. Buffett does not complain about banks. He does not protest the system. He does not write letters to the Fed asking them to regulate fees or raise deposit rates. He does something most people never consider. He buys the system. He becomes the owner. He invests in banks the same way you invest in a savings account, except his investment actually pays him. Instead of being a person getting extracted from, he becomes the person doing the extracting. He looked at the spread, the fees, the volume, and he made a decision that changed his entire financial trajectory. If the machine is going to run, he would own the machine. This is not cynicism. This is clarity. Berkshire Hathaway, Buffett's company, has invested billions of dollars in banks, Bank of America, American Express, regional banks across the country. Buffett saw the model from inside the banking system. He looked at the spread, the fees, the volume, and he realized something. This is one of the most reliable, predictable, profitable business models on earth. Instead of complaining about it, instead of trying to change it, he decided to own a piece of it. He bought the thing that was taking his money and made it take other people's money for him. Bank of America is one of his largest investments. In 2011, during the financial crisis, when everyone else was panicking and selling, Buffett bought $5 billion in preferred stock, plus warrants for common shares. The average person was selling bank stock for 50 cents on the dollar. Buffett was buying. Today, that investment is worth $30 billion or more. $30 billion. He made more money from owning Bank of America than most Bank of America customers will earn in their entire lives. And he did it by understanding the model that most people are still blind to. American Express is another example. Buffett bought in 1963, right after the salad oil scandal. Everyone was dumping Amex stock. Everyone was scared. Buffett saw a good business being sold cheap. He bought hard. Today, his position in American Express is worth $25 billion or more. American Express charges merchants 2 to 3% on every transaction, every swipe of a card, every online purchase, 2 to 3% of billions and billions of dollars. That percentage flows directly to Amex shareholders. Every time you use an American Express card, a fraction of that transaction fee goes to Buffett's pocket. The lesson is not that you should buy Bank of America stock tomorrow. The lesson is that there are two sides to every financial institution. There is the side that pays fees, pays interest, earns 0.01%, watches money vanish month after month, year after year. And there is the other side, the side that collects fees, collects interest, earns the spread, receives dividends, builds wealth while sleeping. Buffett moved to the other side 60 years ago. He has been collecting from the machine ever since. Most people spend their entire lives on the first side without knowing the second side exists. They never even ask the question. They assume there is only one side. There is not. You do not need to buy an entire bank to make this shift. A single share of a financial ETF costs less than one overdraft fee, less than $35. The question is not the amount of money. The question is the perspective. It is understanding that you have a choice. You can be the raw material or you can be the operator. You can feed the machine or you can own the machine. Buffett chose to own the machine in 1960. You can choose today. And here is what Charlie Munger, Buffett's partner for over 60 years, said about this. He said, "All I want to know is where I am going to die, so I will never go there." Applied to banking, the idea is this. If you know that the depositor side is where financial wealth goes to die, go to the other side. It is not a secret. It is not a conspiracy theory. It is just a perspective that almost nobody chooses. But once you choose it, everything changes. First, understand this simple truth. Cash in the bank is raw material for the bank, not an investment for you. This does not mean do not have savings. An emergency fund is essential. 3 to 6 months of expenses sitting in cash is smart. It protects you. But everything above that emergency fund is working for the bank instead of for you. It is sitting there earning almost nothing while the bank profits massively. If you have $20,000 in savings earning 0.01%, that is $131 billion across America, earning 0.01%. That is raw material. Second, minimize fees actively. This is the single easiest move. Online banks, Ali, Marcus, SoFi, pay 4 to 5% on savings accounts. Your big bank pays 0.01%. The difference on a $20,000 account over 10 years is $8,000. $8,000. Some people work their entire lives for $8,000. You can make it just by switching banks. Switching might be the highest return investment of your entire life. An 80% return in one afternoon. There is no stock that will give you that, no mutual fund, no real estate deal, just switch banks. Third, credit card debt is the priority kill. If you have credit card balances, pay them off before you invest anywhere else. Buffett is categorical about this. Pay it off before you buy a stock. Pay it off before you start a side hustle. Pay it off before you do anything else. Because paying off 24% debt is the same as investing at 24% returns. No investment anywhere offers guaranteed 24%. The only return that high comes from eliminating guaranteed loss, and that loss is credit card debt. Fourth, start buying the other side when you can. Bank stocks, financial ETFs like XLF or VFH, the S&P 500 index fund, which contains all the big banks. Every share moves you from being the raw material to being the owner. Every share means a tiny piece of the spread belongs to you. Every dividend is someone else's fee paying you. It is not a complicated system. It is just a perspective that most people never adopt. Most people buy one index fund and call it done. But if you understand the banking blind spot, you see that same index fund differently. You see it as partial ownership in the extraction machine. Fifth and finally, think like Buffett thinks about banks. They are money-collecting machines. Enormous, efficient, relentless money-collecting machines. The question is not whether banks profit. They will profit regardless of what you do. The question is whether you profit from those banks or whether those banks profit from you. Are you the raw material or the operator? Are you the one feeding the machine or the one collecting what comes out? Buffett chose to profit from the banks in 1960. He has been profiting ever since. Every quarter, every dividend, every fee collected. You can make that same choice today. The door is open. It has always been open. Nobody told you it was there. The banking blind spot is not that banks are evil. They are not. Banks do exactly what they were designed to do. They take cheap money and lend it expensive. They collect fees. They generate spread. It is not evil. It is business. The real blind spot is that you were never taught to see it. You grew up thinking banks were safe places to store money. You were never told that the moment you deposit, the money stops being yours. You were never told about the spread. You were never told that every dollar is raw material. You were never taught that there is another side to the equation. Every dollar sitting in a savings account earning 0.01% is like sending a soldier to fight for the bank instead of for you. That soldier goes off to work for the bank's army. The bank profits from that soldier's labor. Your soldier comes home with a penny. That is the entire system. Buffett understood this at 11 years old when he bought his first stock. He looked at the system and decided, I will not be a soldier in someone else's army. I will own the army. That mindset never changed. It made him the richest person in the world. Think about the next 30 years. Keep $20,000 in a savings account earning 0.01%. 30 years from now, you will have $20,060. That is what the banking system rewards. Now take that same $20,000 and invest it in an index fund earning an average of 10% per year. 30 years from now, you will have $349,000. The difference is $329,000. That difference is the exact price of the banking blind spot. That is the cost of not seeing what was in front of you. That is the cost of being the raw material instead of the owner. The system will not change. Banks will not wake up tomorrow and start paying you 5% on your deposits. The Fed will not force them to share more of the spread with you. Congress will not pass a law requiring them to pay fair rates. Nobody is coming to fix this for you. The only change that is coming is the change you make. The only movement is the movement you initiate. Right now. Today. With the exact information you have in your hands at this moment. You see the spread. You understand the fees. You know how the minimum trap works. You know how the score system is built. The blindness is optional from this point forward. Staying on the wrong side of the equation is a choice. Every fee you paid in the past, every month of minimum payments, every year of 0.01% in your savings account, that was not a mistake. That was not incompetence. It was designed. Nobody in school explained the spread. Nobody at the bank explained that you are the product. Your family did not teach you because they did not know. Buffett understood because he studied the model intensely. He traced it. He questioned it. He looked at it from the other side. Now you have seen it too. Now you have the map. Buffett has said many times that risk comes from not knowing what you are doing. Now you know. Now you see the spread, you see the fees, you see the minimum trap, you see the score game, you see which side you are on and which side the bank is on. The blindness is gone. The question now is not whether you understand. The question is what you do next. That action, or lack of action, is what separates those who build wealth from those who finance other people's wealth. The choice is yours, and the clock is already running. If you stayed until the end, write in the comments, I see the other side. There is another video on your screen right now, the next step in understanding how money really works. Thank you for watching, and we will see you in the next one.